Why you should never pay only the credit card minimum. If you have a credit card and you're only paying the minimum payment every month, you could be making your debt much more expensive than it needs to be. And the scary part? Your credit card company is perfectly happy for you to keep doing it. Here's why. Let's say you have a $5,000 credit card balance with a high interest rate. Your monthly minimum payment might look surprisingly affordable. Maybe you only have to pay a small percentage of the balance plus interest and fees. So you think, great, I can handle that. But there's a catch. Paying the minimum keeps the account current, but it doesn't necessarily reduce your balance quickly. Credit card interest can continue accumulating on the unpaid balance. That means a large portion of your payment may effectively go toward interest rather than paying down what you originally borrowed. And the longer you carry that balance, the more interest you can potentially pay. Here's a simple example. Imagine you owe $5,000 and your card has a 24% annual percentage rate, or APR. If you continue carrying that balance and make relatively small payments, you could end up paying thousands of dollars in interest over time. The exact amount depends on your card's terms, your payment amount, new purchases, and how interest is calculated. That's why looking only at the minimum payment can be misleading. Your credit card statement usually gives you more useful information, including an estimate of how long it could take to pay off your balance if you make only the minimum payment. Read that number. You might discover that something you thought would take a few months could actually take years. And there's another problem. While you're carrying a large balance, your credit utilization can remain high. Credit utilization basically refers to how much of your available revolving credit you're using. For example, if your credit limit is $10,000 and you owe $8,000, you're using about 80% of your available credit. A high utilization ratio can negatively affect your credit score, depending on the scoring model and your overall credit profile. So paying only the minimum can potentially cost you in two ways: interest and a higher balance relative to your credit limit. Now, this doesn't mean paying the minimum is always a bad thing. If you're struggling financially, making at least the minimum payment can be important because missing payments can lead to late fees, additional interest, and potentially negative credit reporting. The real goal is to pay more than the minimum whenever you can, while still keeping enough money for essential expenses and emergencies. A simple strategy is this. Stop adding new purchases to the balance, choose a fixed amount you can realistically afford every month, and focus on paying the highest interest debt first. And if your credit card offers a lower interest balance transfer, that could sometimes be worth investigating, but always check the fees, promotional period, and terms before doing it. Remember, the minimum payment is designed to keep your account from becoming past due. It isn't designed to get you out of debt quickly. So next time you open your credit card statement, don't just look at the minimum payment. Look at the total balance, APR, interest charged, and estimated payoff time. Because a payment that looks small today can become a very expensive habit tomorrow,